Thank you for joining us today. Wishing you all a happy Navratri. Today's webinar will be headed by Rohit Balakrishnan, Co-Fund Manager, and Rajat Sethia, Co-Fund Manager at iThought. Markets are cyclical. It's important that we know which part of the cycle we are in or we are going to be in. People are likely to think that they are a genius in a bull run. They think they'll be making the most of the climb. But are their actions in line with their beliefs? Is it in their favor to achieve their particular goals? Being distracted by a bull run, our discipline goes for a toss. So what can we do to avoid that? Without wasting any more time, let me pass it on to the speakers. Hope you all have a fruitful session. Thank you.
Thanks, Tarun. Am I audible?
Yes, sir, you're audible, sir.
And the screen is also visible?
Yes, sir, it's visible, sir.
Okay. So thank you, Tarun, again, and good morning, everybody. And thank you for taking out time for joining us for this session on a Saturday. So all of us, as Tarun mentioned, all of us love a bull market, and we're clearly in a bull market right now. So we thought that this time let's talk a bit about, try to sort of be a bit more circumspect. And this is a very short presentation. I'll just run through it quickly, and then we can have an engaging Q&A maybe. So the first premise that we must understand, and I think it's a well-known premise, and we must never forget this, that markets are cyclical, right? So you go through these various emotions, from being fearful to being absolute despondent, and then that starts the other turn of the market, which is this is how the bull market starts. And then obviously bull market, you feel invincible, you feel absolutely like a Midas, that everything that turns to gold. And then that's then the seed of the next cycle starts. So we must really understand that the cycles, the markets are essentially cyclical, right? Now, if you look at this is the last almost 17, 18 year chart of NIFTY Smallcap, and it's an upward trajectory graph. But if you sort of peek through it more carefully, there are clearly ups and downs, and very sharp ups and downs, and very long ups and downs. For example, the index peaked in somewhere in 2007-8, and it took almost another 6-7 years to come back to those levels. It took from 2007-8 to around 2014-15 to come to that level again, right? And then obviously we had another run, and then 2 very painful years of 18 and 19, followed by the sharp whipsaw that we saw in COVID. And again, post-COVID, the markets have been on a very good run. So again, this again clearly depicts that there is a very strong cyclicality in the markets. Now, having come to that point, now let's understand where we are in the cycle. So again, I will show some data points here, but again, my caveat here is that let's not go on one specific or a few specific data points and sort of see that and just conclude. The point is to really get a broader or sort of get a view from various things, and then sort of make a broad view. We are not making at least we are not trying to make a very strong view that this is how it is, this is how things are. Markets is it's always evolving and always changing. So you need to keep on adapting and keep on updating yourself. So there are no firm views here. Okay, with that caveat. So this is one ratio where we see that there is a small cap, BSE small cap. It's BSE small cap. There is no BSE small cap 100. BSE small cap versus Nifty 50. Clearly, it's sort of breached its previous levels, and it's gone. It's still not it's not yet the all-time highs. Those were in 2006-07, but it's clearly reached a 15-year high, right? But if you see this data point, which is again Nifty Small Cap 100 to Nifty 50, I think some of you would have seen some of our previous webinars. We see this ratio quite regularly. We're still not close to the peak as yet. However, in the past, we have sort of retraced from this level as well. Again, as I said, same index, small cap, one is Nifty, one is BSE. We have a different sort of picture. One is sort of flashing red, the other is not so flashing red, but clearly we are in an upward trajectory. Now, this is an interesting chart, right? Now we've just plotted the various indices return over last 6 months, 1 year, 3 year, 5 year, 10 year, 15 year. The more you elongate the time horizon, the lesser the gap between these three indices. So large cap, you can say Nifty 500 is a flexi cap and Nifty small cap is the small cap index. So really, if you see in the 15-year period, the difference is not that much, right? 13.3% for a Nifty small cap and Nifty 50 is 13.2. Nifty 500 is 14.1. So about 800, 900 basis points, 0.9 percentage point difference between Nifty 500 and Nifty 50 and small cap. But if you sort of narrow the timeline now, let's look at 6 months, let's look at 1 year. The difference is huge. Nifty 50 is 11.5% and Nifty small cap is almost 39%. Similarly, in the last 1 year, something similar. So obviously, these are in 1 year, everybody has been very gung-ho about small cap. If you sort of go back in time, maybe between 2018-19, everybody shunned small cap, thinking that there is no point making any effort in investing in small caps. And then obviously this performance is on the back of that, where people shunned it. And then obviously after COVID, because it was so shunned, people became very, the risk reward was very exciting, right? So Nifty 50 was, or large cap was the place to be during that time. And now it's the opposite right now. And again, it will change, right? So these things keep on happening, right? Now, if you look at something in another segment of the market, clearly there is a mania that is happening, and I don't have any other word to put it out. This is the recent SME IPOs that have happened. So the first column is the size of the issue. So the first company, which is this Basilic Fly Studios, they were in the market to raise 66 crores. And they eventually got subscription from people for about 14,000 crores. That's a whopping 360 times the amount of money they intend to raise. And this is not just one company. This is a few of companies that we've listed here. So clearly, there is a pocket in the market where there is absolutely mania happening. And obviously, this mania is backed by the fact that there are many companies who've done exceedingly well from a share price point of view. And now the euphoria is getting stretched, right? So there is a clear mania happening here. This is another chart that we keep on. This sort of is another facet of, you can say, the sentiment. The last slide was also a segment of sentiment. This slide is also a segment of sentiment of where the markets are. So we track this word, Multibagger, on Google Trends. So clearly there has been a up move from, let's say, last year, same time, but we are nowhere close to the peak as per this chart. Again, I'm not saying that because this chart is saying this, hence it's not a peak, or this ratio was there, hence it's peak or not peak. I'm just trying to put few differing data points from the same vantage point. So we saw BSE small cap to Nifty 50. It is flashing red. We are seeing Nifty 50 to Nifty small cap to Nifty 50. It is not flashing red, but definitely we are in sort of a good zone. We are seeing from a returns point of view, over a long period of time, things are more equal, but in the shortest period of time, small cap has clearly been the place to be, right? Similarly, the other chart that I saw in SME, but this chart is sort of saying that things are not so bad, right? So clearly, it's a good time. There is no doubt about that, right? And we can see from that, in terms of liquidity, the flows in the small and mid caps mutual funds have been very buoyant. And some of the IPOs that are coming in the SMEs, I mean, there are like They are doubling in a matter of days and not even months, right? Obviously, valuations have become stretched, right? And in a sense, you front-ended some of the returns over the last. If you see that chart that I saw, or that table that we showed, uh, in a sense, the returns have been front-ended. However, one nuance point here is that last probably couple of quarters and even before that, since COVID, the earnings growth has been pretty strong, and this earnings growth has been largely driven by companies or sectors which are very cyclical in nature. So you have companies in the engineering space or capital goods or metals who've seen very sharp revival in earnings growth, right? And when you sort of see those companies, they will always look expensive because their earnings are cyclical, and early part of the cycle they will always look expensive. So probably, I'm not saying this is the case, but if earnings continue to grow, the valuations probably will then look not so stretched. But the question is, will earnings continue to grow? We are in an environment globally where the growth has become very, very tepid, global growth. India is sort of in a sense, very, very robust in terms of its macros, but still we are part of the global economy, right? So we will. So in that sense, will growth continue will overall growth, sales growth, and then earnings growth will continue for the companies here? It's a question we don't know, right? So this is an overall nutshell of where we are in the cycle. I honestly don't have a very bullet point answer that no, we are like at the peak now, we need to sell, or that's not how we think. We think in terms of probabilities and various scenarios are there. Clearly, we have had a very good run as an overall market, and yes, given that the markets are cyclical, there is always a chance of things taking a pause or a break, and that is definitely a chance that can happen. Having said all this, right, what is the objective for a long-term investor, right? So our objective is to really earn strong through-cycle returns, right? There will be ups and there will be downs. So you need to make hay when there is a bull run, but also survive and protect what you want during the bad time. That's the objective, and that's how you earn like a strong through-cycle return, right? So how do you do this, right? So in our view, there has to be a method to the madness. There has to be some process which will enable you to manage your emotions, manage what the market is doing, because the market will keep doing what it is doing. But you need to have your own process, your own framework, which will enable you to navigate this roller coaster ride, if you will, right? So what is our process? So we think that if you identify a strong business, you identify a business which is run by a strong management, which has a very good balance sheet, which is run very well by, which has had a very strong history in terms of corporate governance, and you buy this at a very good price. I think this is our process. Now you keep going back to this process irrespective of the market conditions, right? This is your North Star. You follow this as and when the external opportunity is not adhering or not throwing up opportunity based on this framework, you retreat. So it's almost like you're going out to shop and you know what you exactly want to buy. You are going daily and you're saying that, okay, this is the kind of thing that I want. This is the kind of merchandise I want. And you're very clear in your mind. And if you go into the market, if you find it at the price that you want, from the place that you want, you will buy it. If you're not seeing it, you will come back empty-handed. Just that you made the effort to go into the market and put in all the effort to find, but you still don't find it. It doesn't mean that you have to go and do it. Go and do an act of buying. So this is what we follow. And this process or this overall philosophy framework takes time, in the sense that you need to, what is a good business? It takes time and effort to come to that conclusion that whether this business is good or not. You'll never have because we operate in a small cap or a micro cap space, things are still evolving. So you will never have a complete picture. So you need to do much more digging, much more effort to understand. So we go through a lot of annual reports. We understand the industry. We speak to people on the ground, the value chain. the works. So customers, distributors, suppliers, competitors. You do forensic accounting to really check if this business has been run well in the past. Has there been any issues in terms of governance, etc. You look at other industries. All these things are there for you to build that conviction, right? Because you're trying to hold the business for a long period of time, and there will be a bull cycle and there will be a bear cycle. So you need to be okay to own this business for that long period of time. And this is just not at the time of buying. This is consistent over a period of time till you. I mean, this is the basic work that we do over and over and over again. This is basically rinse and repeat. And this process helps us to makes us honest and steadfast, irrespective of what the market is doing. And we'll talk a bit about what it allows us to do as we go into the other slides. So this is sort of our portfolio in action, in the sense that we have about 2/3 of the company which are market leaders, both in terms of number as well as in terms of weightage. Most of the companies are debt free. Most of the companies are there is no research, so you have to go through that extra mile to really do work and find information on these companies. So this is what our process and our philosophy is. But really, what happens in a bull market, right? This process, or the value of this process, really diminishes, right? Because the moment you decide to work on a company, or if you think that this is a good opportunity, price is moving very fast, right? So it moves faster than you can do your research or whatever you want to call it as a process, right? So you do it once, you say, no, I will stick to my process, you miss out. You do it twice, again, the same thing happens. Third time, you say, let it be, let me first buy it, yeah, let me see what happens. Anyway, the price is going up, right? So it's very tempting to ditch your process. And lo and behold, it works, right? So you think, oh, I'm a genius. So you confuse your brains for the bull market. I'm saying not it for you, but all of us are part of this market, right? So it happens, right? So we confuse brains for a bull market. And it works until it doesn't, right? So it stops, right, when you think that we are like, that's the thing, right? It works. There is no point doing all this research, etc. So typically, what does this look like in actual action, right? So you go down the quality curve. Typically, in a bull market, you find, okay, this is cheap right now. We can still buy this, or this company is still available at, let's say, a PE or a price to book or whatever. So you say that, okay, we'll buy this company, but why is this company still cheap in a bull market, right? So you start going down the quality curve. The other end of the spectrum is you start buying things which are very good, but you lose your valuation discipline. So you buy it at any price. So, oh, it's a great company, phenomenal management, phenomenal business, great balance sheet, everything is fine. But it's priced to perfection because it's a bull market. Everybody knows this. So you also feel that, okay, no, this is a great company and price doesn't matter. Well, it actually does, because you're buying an asset. An asset, the asset has to be good, but it also has to make sense financially from a returns point of view, right? So there is lack of valuation discipline. You start believing too much in the story. You think that, oh, this company is so small, this is a world beater, this will continue to grow their sales and profit at 20-30% every year, right? So you start believing in the narrative so much, you forget what is base rates. Same thing happened in the TMT bubble in 2000, or closer back home in the 2003 to 7 bull run, the infrastructure. And we saw what happened after that. There was a huge down cycle for almost 10 to 12 years after that, right? Where companies which burned their hands by doing capex at the top of the cycle they have taken so much time to recover. And I'm talking about companies, right? And so we are derivatives of that as investors in those companies. And so we have much more pain in our hands in terms of money being lost and opportunity being lost and confidence being lost as investors, right? And obviously you think that, oh, I have done so much well in the last 2 years, 3 years, whatever, 6 months, 1 year. I am a genius, as I said. I'll extrapolate whatever returns have happened in the past of my portfolio, of my picks, and I'll continue to extrapolate that. Again, not thinking if you just extrapolate these returns for the next 5 years, what will really happen? I mean, am I that good? And then obviously all this means that you're chasing what is hot today, what is really working today, right? So let's look at some of these charts that are, DLF peak of real estate bull run in 2006-7. It IPO'd somewhere around 2007, and still, despite real estate doing fairly well now, still not crossed those levels. So you can imagine the extent of the euphoria back then, right? And this is like 15 years. It's not a small period of time. You've had you're patient, let's say, you hold, but the mistake that you make at such euphoric times can really, really impact you in terms of opportunity cost, and more importantly, I believe, as your own confidence, right? You tend to throw in the towel at the wrong time, and then many people just exit the market, which is probably the worst thing that one can do for one's wealth creation. Again, another capex story, or a bellwether of Indian capex, if you can say, Bharat Heavy Electricals. Again, huge euphoria, but it's been almost 16 years, still not recovered from that period. Obviously, there are multiple things that went wrong for that company, for that industry. But this is just not a specific call on any company. I'm just trying to portray one fact that if you sort of do a mistake at that point, obviously you could correct that mistake. That's not what I'm trying to say by exiting at any point in time. But these mistakes can be extremely costly, is what I'm trying to point out. Closer, much closer, right? IndusInd Bank. So if you see, 2017-18 was a perfect bull period for NBFCs and banks, and especially private banks, right? So still, it's not yet recovered to that level. It's been 6 years, and it's been a tearing bull market since then, even on a 5-year basis, if you see, right? It's still not recovered from that. So these are some of the things that happen when you sort of make errors in bull market, right? So now coming to this part, right? How to maintain discipline in a bull market, right? Which is what we have been talking about. And it's a very simple point. As I said, we're not going to talk too lengthily on this point. It's more behavioral rather than, and I'll talk specifically on something that we do in terms of specific action point. So I think the first point is very behavioral, and it's very, very tough to do, especially when everybody is making a lot of money in the markets. So the first point I feel is not be in a hurry to make money, right? So the question that one needs to ask again is, going back to that point, is what is the objective as an investor? Are we here to make money on a 3 months, 6 months, 1 year basis? Or are we here to make money on a slightly longer term period, let's say 3, 4, 5 and beyond basis, right? So if you reorient or ask this question to yourself and then go out and look at opportunities, then the answer would be very different. The way you approach things would be very different. And as a part of that, this thinking is, when you are in a roaring bull market, when in a red hot bull market, you need to sort of be sort of not in a hurry or irreverent to the money that you're making during such times. You need to sort of be a bit hands-off, right? If you're too much glued to the music, then it will be very difficult to come out of it. So you have to be a bit more sanguine and say that, okay, I'm not in any hurry to make money in the next 6 months, 1 year. I will make money over a longer period of time, right? Then the other part is that, which is again sort of connected to this point, is you need to have a high bar for new ideas. Anyway, new ideas are far and few, and especially in a market where everybody wants to get in, any new idea will get lapped on very quickly. Especially now in the age of information, where dissemination of information happens right in a jiffy, right? So you need to maintain a very high bar. You should not reduce the bar for your investment just because it's so easy to make money, or the fact that you've made so much money, right? So again, a very behavioral approach. The third point is, you need to have, again, it's more individualistic, but the way we operate is we have checklists, and a checklist is not a substitute of thinking, right? You need to think for yourself, but checklist keeps you sort of steadfast and lets you ask important questions about, so that you don't again miss the bigger picture, or miss the key things that you need to focus on in this whole frenzy of making money, because it's so easy to make money. And the final point I'd say is that you need to understand that, going back to the earlier slides, that everything is cyclical. So some things do get out of hand and do get stretched much before than they need to. The charts that I saw, that we showed you, whether it is DLF or BHEL, the returns got pulled much more ahead in front than the reality, right? So you need to take advantage of that, and so you need to keep selling as obviously it is not a blanket call that you sell entire portfolio and you sit on cash. That is something I think is, having been in the markets, I think it's impossible to do. We all are in the markets. We keep finding opportunities, but whenever something gets stretched, you sell that and you buy something which you think is, which fits into your criteria for the next 3 4 5 years or beyond. So that opportunity, the market always presents itself with, right? So we should use that opportunity as investors who are who are in the markets with a view of, again, I'm saying not next 3 months or 6 months, but a longer term view, right? So things do get out of hand in terms of valuation, and there is obviously this camp of never sell. But as today, where I stand, I think we should be where I stand in the company that I invest in. I feel that, I mean, there are very small sliver of companies which are probably in that camp, and that also I think is a debatable point. But we are at least not in that camp today, and the kind of companies we buy, we definitely want to sell them, but yeah, we are patient in the way we sell, right? So one thing that we do as part of our PMS, and this is across funds, and especially this is again a data point for a live client. So we take our time in deploying money, and it is a function of the thing that I mentioned, right? When I go into the market, what is available to me as in terms of opportunities, right? Somebody who started in May 21, we took almost 10-12 months for that portfolio to get deployed. Cut to next year, May 22, the market was very, very pessimistic, and we pretty much deployed in 3-4 months. And we were deploying like on day one almost 86% of the portfolio. Today, or like the last 4-5 months, it's been much more slow, right? Again, this is not a call on the market, right? I'm again saying does not mean that I feel that the market will correct and then I'm not deploying. This means 3 or 4 things. One, the portfolio is made based on the conditions that are presented to us at that point of time, right? If what the companies I want to buy are not available, then I'll take my time to buy them. I'll wait for my time, right? It's the markets may go up 1,000 points or may come down 1,000 points. I don't care, but it's those set of opportunities that I am focused on. Those are not in my hitting zone, so I'll not buy. And obviously, as you keep working on, you'll find new ideas. And that takes time. Again, you work on an idea today, you'll probably invest it few quarters later. Maybe it is 2 quarters, maybe it is 4, maybe it is 8. We don't know. It is based on the conviction. But we are not in any hurry to deploy money. It is based on the opportunities. Just so happens that when the market is pessimistic, the opportunity size becomes much bigger and easier to navigate. When the market is much more excited and euphoric, the opportunity size reduces, right? So it is much more driven by our opportunity set, and it is obviously correlated or very much in tune with the market conditions also. But we are not taking a view on the market as such. So this way of this comes back to this point that we are not in any hurry to make money, and we have a high bar of hurdle rate or for new ideas, right? So it takes time to build a portfolio, and we follow this time. I mean, we follow this part. So, I mean, as I said, this is going to be a very short presentation. This is just our performance in the last 2 years and since inception. So yeah, I think that's all I had. And as I said, it's a shorter presentation this time. So any questions you have right now, we can take. And yeah.
Yeah, so anybody who has any questions, please start writing them in the chat box and we'll start taking them one by one. So we already have a few questions. Rohit, I guess you can
Yeah,
stop presenting your screen.
yeah.
So the first question is about why are we booking profits when stocks are already rising in this market? So this is exactly what we briefly touched upon in the presentation towards the end, the importance of selling. Just one quick check. Am I audible? Am I
Yeah.
clearly? Okay. So this is exactly what we touched upon in the last part of the presentation, the importance of selling. And just like we saw some of the charts, which were more for illustration purposes, that sometimes in a euphoric market, valuations become really expensive, and that may not be a bad time to, sell some of those shares. And right now, this is exactly what we want to convey the point that markets are in a slightly expensive zone, and that's exactly why we are taking time to build the portfolio. But it also uh, you know indicates to us, and it is also important now that we start selling some of the shares while we are not exiting any of the companies completely, but wherever we feel the valuations have run much ahead of their fundamentals, we have started selling some quantities so that we can take advantage of this rising market. Just like one takes advantage of a falling market, this is exactly the opposite. And this is what we are trying to do. Uh, so the second part of the question is in this case where we are selling. So in such case for long-term investors, how will you use stocks to build wealth in such a scenario? So see, wealth building, creating money, generating returns happens when you look at stock by stock. Ultimately, you have to look at the portfolio. You buy every stock hoping that it will double or more than double in next 3, 4, 5 years. And at the portfolio level, you look at the return. So wherever you see pockets of expensive valuations, you have to get out. And wherever you see pockets of undervaluations, you buy them. So this is a never-ending process, and we are operating in a small cap space wherein, which again was briefly touched upon this topic, that these kind of companies you really have to get out, and it is not easy to predict the future at any point in time. A lot of even large cap companies have fallen to zero just because something went wrong. So when it comes to small cap companies, you have to be extra careful. While following our process and philosophy, we are able to weed out all the bad names that we can think of. But at the same time, whenever you invest even in a good company and their valuations become expensive, again, you come back to the point that you need to sell. And when you sell, you get money and you redeploy in companies which are good, as well as their valuations are good as well. So this combination of buying a good company at a good valuation is what generates wealth in our view in the long run. And this is a never-ending process. We just keep doing it again and again. Rohit, you want to add anything to this first question?
Yeah, no, I think just one point that again, if it's, it has to be a function of valuation. That's the most important point, not the fact that the stock has risen. Uh, we've had stocks which have gone up 700, 800, 1,000, 10,000%. I mean 1,000%. So in the portfolio. So it's not that because the stock has gone up 1x, 2x, 5x, so we have to sell. It is a function of what we think 3 years out or 2 years out, what the earnings could be, and what the market cap of the company today is. And also, it's not like a blanket selling. It's more staggered selling. So we give ourselves that flexibility of being wrong and still having the chance to play the rise. So yeah, that's all I wanted to add.
So, second question is about choosing the multi-baggers in the portfolio, and uh, and uh, so the question is, will you let it construct multi-baggers while choosing the stocks, or do you solely approach it from a trade perspective? So we just said that any company that we like to invest in, we look at it from a 3 to 4 year perspective as the bare minimum time holding period, because that is the time period we believe it can take, and it generally takes for a company to double its profits. And this is how we approach any company that we invest in. We do not invest in any company thinking from a trade perspective that we will invest today and probably next 2 3 months or 6 months or even 1 year or 2 year we will get out. While markets may give you opportunities for such give you such opportunities where stocks double before their profits doubling, valuations become expensive, and when valuations become expensive you get out. But we never enter thinking that. We only look at the profit growth of the company and how sustainable that is. And if the profit growth of the company continues, we will not even think of selling, getting out of that company. And as long as we see the growth trajectory of the company is continuing, we will stay invested. And in a company where we are invested for a longer period of time, where we have tested the management, where we have understood the business far better than most of the market participants, we are then okay even with lower returns in such companies. And the reason for that is risk level in such cases go down in our view. So we are okay with lower returns as well. So yes, this is how we approach companies, and this is how you let your companies grow bigger and bigger and become multi-baggers. For example, today in our portfolio, there are few companies which we are tracking for more than 5 7 years, which we are owning for more than 5 years, and we continue to own them. And we never thought that those companies will look so great after owning them for 5 years. When we first bought them, maybe we thought it will give us good returns, and 3 4 5 year is a time period when probably you may want to sell them. But standing today, we see them for the next 3 to 4 years also. So essentially, you are saying that owning a company for 8 to 9 years as of today. How the scenario will change, we don't know. But this is how you evaluate a company, evaluate its performance on a regular basis, and keep changing your view as per the data, as per the information, as per your conviction. Yeah, so that's about it. Ruth, anything you want to add to this question?
Just one small thing, that when we are choosing or constructing a portfolio, we don't look at this multi-bagger thing, right? Multi-baggers happen in hindsight. Our focus is on risk and reward. So our focus, as Rajat said, in terms of can this business grow profits over the next 3 4 years, and the other things, that how well has the business been, how strong is the balance sheet. So the multi-bagger aspect is not at all. So we are not trying to look counterintuitively at a specific return, that this is the return that we want. And that's not what our thought process is. We are focused on the risk and the reward that we have, and more focus on the risk part, that we should not we should get into a strong ship, and we should be able to be in this ship for a long period of time, which is driven by the strength of that ship, the captain of that ship, and also the valuation that we buy in, right? So multi-bagger is something sort of an after effect of that. If you do that well, then things play out, then it's a multi-bagger. That's so. But we are not looking that, okay, no, this company that we want to invest, this has to be a 3-bagger in next 3 years or 5-bagger in next 3 years. That is never the question that we sort of go with. That's not the first thing that we look at. We look at the strength of the business, the strength of the management, and the valuations in conjunction with these things. And if those things are something which makes sense to us, then we go ahead. Whether we make money for the next 2 3 years, we don't know. Sometimes returns happen much later. Sometimes returns happen much before. So all things can happen in the market, right? So, but again, as I said, we need to have a framework which will, returns is an output. Returns is the end object, is the end thing which happens. But the path to that returns could be very, very different. So that's not the first way we think. In terms of this is how the multi-bagger is not what we want. It's obviously what we want, but it's not what we sort of seek in the first place.
Cool.
Yeah,
We'll
that's
move
what I
to the
want.
next. Sure. So yeah, let's move to the next question, and this is: what are the sectors you are currently bullish or finding value? Uh, so so as a generic point on the sectors or the companies, I think what we like to do at iThought is that we go for companies or the sectors which are out of favor, sectors and companies which are going through a temporary dull or out of favor, you can say, are usually the ones where markets are not willing to buy their shares and ascribe them good valuations, which essentially means they are available at attractive valuations. So, and that is our hunting ground. That can also mean that you are early into a idea, and we are absolutely okay with that. Being early is absolutely fine. Rather, on this point, one example that comes from our portfolio companies, and this is our approach now. We invested in a company which is our top performing positions, top position in the from the point of view of the returns it generated, maximum holding period, as well as the top position in terms of allocation today. So this company, we invested with just 2% allocation as the first allocation that we did to this company, and it ultimately we ended up investing 11-12%. But when we invested in this company, we were really early. For the first 2 years or so, although market company was doing well, but market somehow was still stuck that whether the performance is sustainable or not, because from the last 7-8 years this company had not done anything remarkable. It was going through its own down period because of various factors, but company was good, management was good, balance sheet was good, it was market leader. It was going through bad phase, and that bad phase has started changing for the company, but market was still not willing to ascribe any value to it. So market was ignoring it. We started with 2% and we were early. But since we tracked it for many years and during our holding period, we were seeing the changes happening. We started allocating more money, and the point I'm trying to make here is that we were early, and that's how you really find value in the market. So some of the sectors that the question is about, that we think are we are bullish or are offering any value. So some of the sectors that can really do well from here, and whether we are finding value or not is another question. But some of the sectors that we think should do well from here onwards are the likes of, let's say, real estate, capital goods, some of the infrastructure companies, because some of these companies or some of these sectors haven't really done well for a very long period of time. Some of the sectors which are being ignored temporarily in the current times are like pharma or IT. So whether we find value in them or not is a question of specific company, because every company is different in its own way, and you need to go company by company and see whether that company is still offering you any value or not. Rohit, you want to add anything to this?
No, nothing.
All right. So how can we recognize whether the markets are peaking out? Honestly, once they are peaked out, after 1 year of that, you can look at it and say, yes, markets are peaked out. So this was on a very lighter mode. I want to say, well, we cannot do that. What we can do from our side is that you just keep looking at some of the indicators, which you can have your own set of indicators. What we look at, we have presented today. Market peaking is always a prediction of the future. What happens in the market, whether they are peaking out or bottoming out, it's all about the future, and it's very difficult to predict. One thing which we will share with you on the peaking out aspect particularly is that if you look at the market from 2002 to 2005, it doubled. Like BSE Sensex doubled in a matter of 3 years, which is a fantastic returns. And everybody thought markets have peaked out. Then they doubled again in the ensuing 2005 to 2007-8 time period. Nobody would have thought about it, that markets bull run will continue for another 3 years or 2 years. But it happened. At the same time, if you look at what happens in the market in a downtime, from 2018 peak to 2000, sometime in 2019, markets were tanking, and they had, small cap index had tanked by more than 40-50%. And it started recovering afterwards. And then COVID came. It fell again. So nobody could predict what will really happen in the ensuing time period after seeing such a drastic rise or such a drastic fall in the markets till that point in time. Despite those heavy trends, the trend continued. It did not reverse for another 1 year or 2 years, but then it reversed. So it's difficult to say what will really happen. All you can do is have a very robust process which will protect you no matter what happens in the market. While you cannot be against the trend of the market, but your portfolio can be resilient, which will help you during the bad times. In a rising times, everybody makes money. All you can do is selectively sell wherever you think valuations are expensive, or get out of the companies where you thought you did a mistake. But in a falling market, you will be with the trend, your portfolios will also be falling. But what you can do is what you can do from your side is to ensure that the companies you're invested, portfolio that you're building up, is resilient enough to take that kind of correction. And companies are filled with market leaders wherein they use such opportunities of market turbulence to their advantage by becoming stronger. If economy or a sector is going through a bad time, market leaders should ideally gain market share. They should become stronger, because loose companies with debt and all will not be able to sustain or tolerate that kind of a beating, and they might get out of the market, and that's an opportunity for the market leader. So that is the kind of portfolio you want to build, wherein you are positioned very well for both kind of peaking out or bottoming out of the markets. Rohit, anything you want to add to this?
I'll just add maybe 2 points. So I read somewhere, I don't know who said it, but it's a saying that tops and bottoms are found by only two people, God and a liar. So, so either you're a god or you're a liar. So I think it's markets are, it's not deterministic, it's probability based. There are multiple scenarios can happen. As Rajat gave a scenario where everything looked so bleak, and one would have thought that now it can turn, but again it became so bleak because of COVID. So anything can happen in markets, and even within markets, there are cycles within the market. So one sector or one pocket may be overstretched, but there are other pockets which will be completely ignored. So even within a cycle, there are sub cycles. So you can always make use of that. So markets, Nifty hit an all-time high in February or January of 2020 before COVID, but the broader markets were completely in shambles. So you will have these, like even though the market in a sense peaked out in in Jan-Feb 2020 from Nifty point of view, but the market had actually peaked in January 18, right? So it really is very difficult to know peaking of the market, as Rajat mentioned. What you need to focus on is your individual companies, the ones that you have in your portfolio. You have to keep looking at the ones that you own and see that what is the valuation that they are trading at, what is the future growth that these companies can probably look at, and does it make sense to sort of take some money off the table and redeploy into something which is more sanguine or more let's say comfortable from a valuation standpoint. That is something that we do. We don't take such deterministic call just saying that, okay, this is a peak now, let's just sell everything and get back into cash. That is something that we don't do, and I don't think is something which is useful to do as investors, because those are very, very difficult calls. And many people exited during COVID and they couldn't really re-enter back in terms, because they were just waiting for that correction and it never happened. So much better to focus on those things rather than being very deterministic that the market is speaking out. And
Yeah, so I think the latest question which has just come in is also related to this, which is like, why are we buying? Then why are we buying in such a high price market? So we have said that we only look at stocks, and we don't really focus a lot on what is happening in the markets, because when we say high price market, low price market, peaking out, bottoming out, it's all about future prediction that we are trying to make. And this is not our job. There's a very good book on this. The book name is Super Forecasting, The Art and Science of Prediction. It talks about how in every cycle, those market pundits which come in and talk about what will happen on any topic in the economy or the country, how they are replaced in every cycle by some other guy because they got it all wrong. And if somebody is making a prediction or every now and then, once in a while he or she will get it right. But it's very difficult to do that twice or thrice in a row. Nobody has ever done that. And there is no formula to do that. But what we are trying to do, we have learned it. So there is a formula to learn it. And what we have learned, we are trying to practice it, and it is working very fine for us from the last 10, 12 years. So just again, what we are, when we say peaking out or bottoming out, we are trying to, in a way, time our entry or exit. We don't do that. We don't do that. We only look at the temperature of the market using those indicators and then try to adjust our allocations. If we are lacking something, we will go ahead and buy it. In 2018, at the peak of the markets, there were many stocks that we had bought, and we didn't know that markets are going to peak. We bought those stocks because they were good on the fundamentals basis. We could see that their earnings could grow in the next 2 to 3 or 4 years to come. And some of those companies really played out very well. Some of those companies, we are still owning them. So we look at those specific names and move ahead.
The next question is, if I invest in NIFTY PMS, do I have an option as investor to choose staggered investment? So certainly. So 2 points here. So one, when you start for the PMS to be active and for us to be able to buy and sell stocks in that portfolio, the portfolio has to have 50 lakh rupees. Only then we can start. So, however, once somebody starts with 50 lakhs, we definitely encourage that person to keep adding more money. We focus a lot on doing SIPs because at any point in time there are ideas that we are able to find, and it is important for all the investors to participate in all ideas. As Rajat mentioned, we don't typically sell something in 6 months or 1 year. So then it becomes very important that somebody who's, let's say, started last year or a year before that, and now we are buying something different, but something new. So that person should also participate. So in that way, SIP is something that we essentially encourage everybody, whatever the amount. And if you continue to do that, it is a very, very good way of subverting this question of peaks and bottoms and market being very high or low. You just start methodically just adding more money and leaving it to the investment team to find out opportunities. So yeah, we encourage people to add more money in a staggered manner. However, as part of regulation, you need to start at 50 lakhs on day one. So that is something that's regulations.
Next question is about what do we do with the idle cash if we are not able to invest in the portfolio, in the stocks, given markets may be expensive and you are not able to find companies at your entry levels where you are comfortable with. So we park the idle cash in liquid funds, wherein you get some percentage points. But we don't really see that cash as idle. We see that as a as a powder for whenever there are market corrections. You should be able to deploy that cash very quickly, because sometimes corrections happen for a very short period of time, or specific company may come to a level for a very short period of time. So you have to be ready, you have to be positioned well to take those opportunities. So that cash really is really powerful tool. Like that idle cash lying in the portfolio is a very powerful tool to enhance returns.
Next question is, do you expect correction in near term?
I think we have answered it.
Yeah, we don't know, and anything can happen. Yeah. So what is the average holding period of a specific stock? Will you come out of a counter? Will you sell completely? It's complete exit. See, I think when we buy a stock, at least we are looking at next 3 to 5 years. That's our going in thought process. If the journey and we give enough time for the company to perform and let the hypothesis that we have play through. The stock price has very little to do in this time. The stock can do very well or cannot or may not do well. There are both examples. As long as what we believe the thesis is if that is sticking, we will continue to hold. In terms of selling completely, if we are wrong, we sell out completely. There have been examples in the past where we felt that we have been wrong and we sold out completely. If there is a question of valuation becoming very expensive, then probably we will trim our position. We will sell in parts and then slowly and steadily exit. Anything you want to add other on this?
No, that's about it.
So the next question is, what is the market cap ranges? It's a very broad range. The range is maybe around 200 crores market cap or slightly below to 10,000 crore market cap or 15,000 crore market cap. So that's the range.
So how do we identify compounding stocks, and compounders are trading at a high PE? It's one way of looking at it, that compounders are trading at high PE. In our view, I think very high quality companies, mostly consumer names or companies which are part of a trend or euphoria right now, like electric vehicles or hydrogen or semiconductor, things like that. Those sectors are trading at high PE. And the reason for that could be, people jumping in, could be rationality for sure. Other could be lack of such high, great quality companies in India and depth of the markets. But main question is how to identify compounding stocks. So compounding stocks and high quality stocks are different. Compounding stocks could be something, wherein a business which is good, but has gone through a temporary phase of, bad times in its business or the industry or management change. Sometimes, capital goods companies are going through a bad phase of the last 8-10 years. Same is for the case for real estate companies. Some companies might go through a temporary phase, promoters changing hands and not focus not being on the business and all of that. So all you have to do is stick to your process. What we do, we can share that with you. You have to stick to your process. You have to see what has worked for you, what you are comfortable with in terms of the business nature of the business and the patterns that you see and the valuations that you like to pay. So we have shared all of that with you in the presentation. So this is exactly what we do to find our compounding stocks. Yes, you sometimes get it wrong. And when you get it wrong, you may sell out fully, which is exactly what just Rohit shared in the last question. But at the portfolio level, you have to get some of the stocks right, and following the process and the philosophy that you have designed and that has worked for you. In our view, one can comfortably get those compounding ideas. Rohit, anything to add on this?
Yeah, I would say that it's a misnomer. I think that most compounding stocks are high PE. I mean, one classic example was ITC. If you maybe 10 quarters back, right? It's a classic compounding stock where the earnings will continue to grow at 10-15% every year. I mean, over a long period of time. But it was completely out of favor. You've had such names. HUL did not do anything and was available pretty cheap during 2003 to probably 2007-8, right? and then it had a huge re-rating. So you will have such, I mean, compounding stocks. What are compounding stocks? Compounding stocks are those which continue to grow their earnings at a decent rate, which will continue to compound their earnings, right? Now, the price that that market accords to it can be driven by a lot of stuff which is not related to the compounding earnings of that company. There could be a narrative around it, as Rajat mentioned. So it's not necessary that compounding stock have to trade at high P. I don't think so. Yes, maybe you will have to have the gumption and the courage to go out against the market and buy something like an ITC, but it was very in hindsight, it looks very easy, but it was as now what is called a meme stock, right? But that company was giving you 5% yield, right? And today also there are opportunities like that. We need to see what is not in favor, but has the qualities of a compounding stock, right? Which is a market leader, which has very strong fundamentals. So I mean, there are opportunities even today. Can you tell about one, two stocks?
Sorry. Just one more point on this. See, where high P companies are there in high quality names, those companies are large in size, where a lot of money can come in. Mutual funds, institutional investors, foreign institutional investors, they come in. But when we talk about small companies which do not have liquidity in them, big investor is absent there. Institutional investors specifically are absent there or very low in presence. So there is an opportunity to unearth those companies, go out and meet the promoters, do plant visits, and understand more about the company first time in the country, or let's say you can be one of the first few people who will understand those companies. And re-rating of those companies, valuations like in the way we measure, let's say P by E or EV by EBITDA, it has still not happened. So that is another reason why we really see that there can be opportunities in the small cap space. Yeah, Rohit, next question we can go to.
So can you tell me about one, two stocks where investment didn't work out? Yeah, so one company where, without naming, we were quite bullish on the way the company, the opportunity that the company had and its market position. But they went out and did a corporate action which did not make sense to us. And we tried to understand, we were on the con call and tried to sort of ask the question and to really understand the rationale. There were a lot of discrepancies in the way that this company was talking about, and the way they the other company which they had a corporate action with, which is a global company, they were talking about. There were a lot of difference of facts also, which was a bit odd. And at the outset itself, we didn't understand why they were doing this. So we took a very strong call of exiting that company fully. And despite we think that, that thesis we thought was not work. Our thesis fell completely flat on what we thought would happen. So yeah, that happens. It's a dynamic world; anything can happen. So you need to be prepared that these things something will change.
Yeah, what was peculiar in that company was that till that time, if you track the management, they were pretty honest, pretty straightforward. In terms of business execution, they were top notch in their industry. So till that time, everything was so good. But when that transaction happened, we could see the facts being shared with us, and it was all public information. There were press releases by both sides of the management. We could see something was not matching up. So we had to change our minds, no matter how much we really liked the company or our analysis told us initially that it's a good management. When we saw there was a red flag, we had to change our mind and we got out.
Next question is, what valuation metrics are used while buying specific sectors like capital goods, FMCG? So let's say, so I'll give you probably a couple of examples, and this is again what we do, and there is no probably right or wrong in this. So in capital goods, typically earnings are lumpy, right? So probably using things like EV/EBITDA or price to earnings may not be that useful. So we typically look at price to book because book is more smooth and less lumpy. So in capital goals, we look at that. Also, we try and see that, let's say, in a good cycle, what this company can earn, and related to that, what is the earnings today? I mean, what is the market cap today? Those are the two things. In FMCG, again, we look at sometimes price to sales. Some of the companies, when you look at price to sales, typically you get a good reference point and you compare it with the history at which they've traded. But yeah, I mean, these are the two metrics that we see sometimes in capital goods and FMCG.
So
What
broadly, we can say that there is no one metric that you will go by. There is no, you know, sector that you will say that this sector should deserve only this. It's the confluence of a few metrics that you will try to corroborate your valuation range with. Secondly, ultimately, what really matters is the quality of the business, which can be measured by return on capital, if we have to talk about just one metric, and the sustainability of that. Any business that can generate high returns on capital, can sustain it, will get higher valuations. So our idea as an investor is to find companies where those characteristics are there, and where if return on capital, intrinsic return, intrinsic ability of the business to generate high return on capital is there, but that's not happening today for certain reasons. Our job lies in finding such businesses and seeing that journey happen, that from low ROCE on a reported basis to high ROCE. And those kind of companies, if you are able to find, you will see their valuations getting re-rated. Their valuations, entry valuations may not be on a reported basis, that be giving you the true picture. So it's very, that's why, it's not just one metric and multiple of metrics.
Next question is, how is our PMS different from other? So I don't know how from a differentiation point of view, but there are few things that we do differently. One is we don't follow a model portfolio approach, which is very I think most PMS do that. So I think which is counterintuitive to us. The second thing I would say is that all the three fund managers have they eat their own cooking. So whether it is Shyam or me or Rajat, Shyam is the largest client in the fund, and both Rajat and me, we have almost 90 to 95% of our liquid net worth in the same stocks as what we buy for our clients. So I think these are two things which I would say are different. But from an investing framework point of view, I think it's very standard whether you invest in large cap, small cap, mid cap. Investing is the same all across. You need to buy a good asset at a good price for the long term. I think it's very simple, but yeah, it's simple but not easy. From that perspective, we really try to do things based on the framework, because we are, again, as I said, it's our own money that we invest in the same stock, and we do it the way we think is right for our money, and similarly, so the risk focuses on the risk very much, and yeah, we try to follow our framework to the T, and we are not in any hurry. So the next question is, sorry, you want to add something?
No, I was moving to the next question.
Sure.
Yeah. So how many stocks? Around 20, but if you look at the top 10 stocks, they will be forming up 60% of the portfolio as of today. However, and then there is a long tail of 10, 12 stocks wherein we are owning somewhere between 1 to 4% each. Our idea is to build a position in a stock at even at a lower level of allocation, we are okay with that. And as the conviction goes up, like the one or two examples that we, without naming them, we shared that, we started with 2%, we took it up to 11-12%, and there have been few more examples like that where we have really increased our allocation. Only challenge that comes sometimes is that if the company is really good and performing after you started buying it, everybody likes it and valuations go up, so you are not able to build the position, and that's okay. But you need to give time to your position. You need to build conviction for sure before you commit more capital. So we feel over a period of time, as the conviction levels go up, as the delivery in terms of performance, business performance comes up, those allocation levels go up. That's how we look at portfolio construction. And for different set of investors yet, yes, endeavor is always to have same portfolio, but this is difficult because of entry levels, entry timings. So somebody who joined us 2 years back and somebody who's joining us today may not have, there will be some overlap of stocks, but some stocks we cannot buy today because we do not follow model portfolio. We do not blindly invest in companies irrespective of their valuation levels. We have emphasized it enough till now that entry valuations matter, and they matter a lot. It is completely one thing to buy a good company and completely another to buy a good company at a good price. You want to get the valuations right. You want to get it right for sure. So people, so the clients who are coming today, we will not buy certain stocks because their valuations have gone up, while those stocks may be lying in the existing client's portfolio. But buying today at current level does not make sense. Rohit, you want to add anything to that?
No.
Okay, you can take the next question.
So the question is, some of the stocks have corrected, but in my portfolio, some of the stocks have corrected 60% in the last 1 year. These stocks are given. I think, it's very difficult for us to give such a blanket answer without knowing what these companies are or what these companies do. And in general, I would say, the only answer I would say is, as I was answering in a separate point to an earlier question, that see, returns are what we can see and measure. That's not how we should only look at. Obviously, that is all the reason why we are investing. We want returns. But we need to look at the underlying aspects of the business, why the business is doing well or why it is not doing well. Will it change going forward? And the stock price is after that, or the stock price returns are after that. So I would urge you to look at the businesses that you hold, what they are, study them, understand them, and if they are good and you think the next few years are good and relative to that the business has a lot more potential, maybe you can hold them. If you think they are not and it was a mistake in the first place to own these companies, then you probably should exit, irrespective of whether they are in loss or profit. That's all I would say. I think the next question is already we had answered. What are the sectors you think are out of favor? See, it's tough to think. It's tough to really call out. But yeah, out of favor, I wouldn't say. But some sectors like agrochemicals, specialty chemicals in general are going through a tough business period. Now, we need to find whether that is in conjunction, whether the stock price and the valuations are also relative to that. But from a business cycle point of view, they're going through a very tough period. Agrochemicals are going through a very tough period. Chemicals are going through a very tough period. There's been a very strong inventory destocking, which has been, people front-loaded their demand because there were so many supply chain issues and there were a lot of issues around containers being available, etc., etc., etc. And everybody bought a lot and then realized that maybe they bought too much and that inventory has been destocked, or that unwinding has been happening for last 6-7 quarters and it's still continuing. So a lot of businesses are going through a very tough period. A lot of inventory losses are happening. So those areas are interesting to study from a business standpoint, because the business is going through a very challenging period. Now, whether the valuations are there or not, we have to see. Next question is sorry, Rajat, you want to add?
Yeah, you usually one sector, not all the companies, any sector will be going through a tough phase. When real estate was doing bad, Godrej properties were doing really good. Similarly, you look at any sector, usually you will find one or two companies which are doing good because they are really at the top of their game, and they are taking away market share. So you can still find companies, which are going through bad phase, sectors which are going through bad phase, and companies in them which are some of the companies which are doing good, and most of the companies which are not doing good as good. Being retail investor, what is the best time, and do we have any YouTube videos on that topic? Yes, we have a lot of YouTube videos on. If you check YouTube handle channel of ours, I Thought Advisory, you will come across many videos by Sham Shekhar on diverse topics, including this. And the first part of the question, what is the good time? We have discussed, timing is not really something that one should do because forecasting is not something that anybody has command. Either you have to be a god or a liar, like somebody said. So you have to start at some point in time. However, you should choose the PMS service carefully. Doing model portfolio is not really in the favor of investors in our view. Somebody who will take their own sweet time when markets are expensive is something we believe is the right way to approach it. We have talked about how we approach our portfolio construction, what all we do. You can take a call basis that.
Next question is, how do you buy stocks in such a high price market? Do you oversee the low value companies? So you have to be patient. You have to focus on the business and the individual company. And there are always, at any point of time, there are some opportunities which are always there. So you focus on them. To create a portfolio with, let's say, 15, 20 names, it takes time, especially in a high price market. But the only opportunity that you have is to be patient and not rush into things and not be in a hurry, as I said during my presentation, to make money as such. Do we have an investment plan? So we typically don't buy in IPOs. I mean, we typically stay away from IPOs, and we have not invested in any IPO so far in our career, and not in the fund as well. What is your strategy of cash holding? Cash holding is an outcome. It's not a strategy as such. It's the end outcome. As I said, I have 100 rupees in my pocket. I go out in the market and go and shop. What I want to buy, I buy. Whatever is left is cash. Today, I'm only able to deploy 30-35%. So the remaining is cash. Doesn't mean that I'm not going to the market every day. I'm doing my work every day. As Rajat was mentioning, this process of trying to find opportunities, trying to look at companies is something that we do on a day-to-day basis. They will find when the company that we want to buy and our conviction both match, then we go out and buy. The market may be at 1,000 points higher or 1,000 points lower. It doesn't matter. So the strategy is, there is no strategy of cash as such. We invest, if there is a lot of cash, then we invest in liquid funds, because if there is a lot of cash getting accumulated, then we just park it there. Next question is,
for a new portfolio. Sorry, Rohit.
No, you were getting stuck, so that's why. Yeah, now it's fine.
Okay. So for a new portfolio, is there any client-wise angle to the deployment process? So client-wise angle are captured in 2-3 aspects. One, the risk assessment is done, and before opening an account, we try to understand whether a client is really comfortable with the small cap strategy or not. And secondly, some of the clients may have a restrictive list of ideas where they do not want to invest, or for various reasons, could be professional, could be personal. So we take care of those angles there. Yeah. And is there a minimum is 50 lakhs is too high for a retail investors? How one can avail professional advice? Please get in touch with our team. We have a beautiful product for people who are not able to start with 50 lakhs because of the regulatory requirement that we have. It's called Milestones to Wealth. It is absolutely for our retail investors, and the target is to grow the retail investors to a level where they can also start a PMS advice services. So please get in touch with our team, and they will be able to help you with that. So next question
is the market. Market bottom is the perfect time to invest. The only question is, can you predict the market bottom? That's the only challenge. Unfortunately, we are not equipped to predict the market bottoms. And I guess, as I said, only God and liars can. But on a serious note, I think it's futile to predict market bottoms. It's a good intellectual exercise, but very difficult, and I don't think it's useful to put in a lot of effort there.
Next question is specific about the banks that they are seeing contraction in their NIMs and basically the profits, and how far it may be continuing. Well, it's a function of as soon as the credit growth picks up, there will be a lot of demand, and supply side will not feel the pressure, which is the banks. We were also going through a time period when banks were really constrained by their asset quality. Hopefully, that is now all in the past, and going ahead as they grow their CASA, as the demand for credit goes up, they should be. And for the risky sectors, more specifically, demand from the riskiest sectors. So in the last few years, because of the poor asset quality, banks have been more focused on lending to the right borrowers and more safe borrowers. But that is not exactly the whole spectrum of banking that one sees. They were restricting themselves from lending to the slightly riskier borrowers. And when that starts to begin, you will see NIMS expansion also taking place. Change in culture of all generation bank will sustain or not. Well, culture is always difficult thing to change. Well, we are who we are, and we will remain who we have been so far. That's what usually happens with all of us. So difficult to do that. However, every once in a while, you will see one or two companies coming up with these cultural changes taking place in the organizations. However, that takes a lot of time. It is never going to happen in a period of 2 to 3 years.
The next question, I think we have answered this question. IPO. So the other question is, how many stocks you are holding? So I think at a corpus level, I think we would be close to 25, 30 stocks, but some of these stocks are not there in some portfolios, or because they've run up. So individually, I think we'll be close to 20 to 22 names, and we don't have any restriction as such. But yeah, I don't think we'll go to 50 names also. We look at, as Rajat said, top 10 should be between 60 to 70%, depending on where we are in terms of market cycle. And that's what our broad thumb rule is.
Yeah, I think we should look at top 15 names because rest of the names are usually the ones where we are either exiting or where we wanted to build a position and market levels, prices went up, valuations went up, so we couldn't do that. Or we are still testing out the idea. We have seeded the position, but we are not, we are waiting for some certain triggers to play out and before deploy more capital. So we will always have that kind of a tail, but top 15 will have 75 80%. That's what we should look at. Value and growth investing in interest rate cycle. So well, all investing should be value and growth at the same time. These are not different. Academically, probably what we say value is something which is cheap, going by the conventional norms of valuation metrics like P by E, EV EBITDA, P by B, and all of that. And growth, going by the conventional norms, is something that we say is growing at a very high growth in terms of either revenues or profits or both. But ultimately, it is the combination of the two, valuations as well as the growth aspects of the business, clubbed with other things that we have talked about, quality and management. It's the combination of the two, or the marriage of the two, that has to happen for a successful investment to take place. So in any cycle, now we are talking about interest rate cycle. So in any kind of cycle, be it interest rate related cycle or anything else, you will see companies which will be benefiting from that in that cycle, in that phase of the market or the economy. Even in COVID times, when all of us really thought for a moment that the world is coming to an end, there were some companies which were making the most of it because they were in the pharma space or the PPE space or the likes of it. So our job as an active investor, as an active fund, is to find such opportunities where we can take advantage of the cycle, which can last for 5-10 years or so. Rohit, anything you want to add to this?
Yeah, I think just one point: all investing is sensible investing, and anything which is sensible is what we need to do. Value and growth are like, these are all, you need to name these things to be able to sell your stuff. But it's all investing which is sensible. I mean, you want to buy something which is growing at a price which is making sense to you. That is all what it is. So I guess I think we've answered all the questions, and thank you so much for all these questions and all the interest. Really appreciate it. And thank you for being patient and spending the time with us on this Saturday morning. Thank you. Thank you very much. Have a good weekend ahead. Thank you, guys.
Thanks, everyone.